Hello, everyone. My name is Joanna Nasr, and I lead the paying taxes topic in the Doing Business report. Today, I will go over I'll give you some background information about the paying taxes indicator. I will discuss why it matters, what does the indicator cover, and then share some good practices in the area of paying taxes. Why paying taxes matter? If we look at the data from the enterprise survey database, which surveys actual firms in countries globally, we can see that tax rates and tax administration, the two bars in yellow, are among the top 10 areas that businesses in the world they found to be an obstacle for doing business if these two measures are burdensome on the firms. The enterprise survey data has inspired many of the doing business indicators for the inclusion in the report. That is why those two dimensions of the tax environment, tax rates and tax administration, are included in the doing business project. What is or is not measured by the paying taxes indicator? The indicator is comprised of 4 sub-indicators. These are the 4 sub-indicators: total tax and contribution rate as percentage of profits, number of tax payments, the time to comply with tax obligations measured in hours per year, and the 4th sub-indicator is the post-filing index, which is a score between 0 and 100. I will discuss each of these sub-indicators in the next slides. First of all, let me start by reminding everyone that all the indicators of doing business are constructed based on a standardized case study scenario. This will allow us to collect the same data across all the countries and allows for the comparison between the different tax systems in 191 countries. The basic premise of the standardized case study for paying taxes that it is a company that is a limited liability company. It's always in its second year of operation, so it's a new company that's always in the second year of operation, and that company is 100% domestically owned. We assume we have 5 owners, and it has 60 employees. We can see the distribution between managers, assistants, and workers in the slide: 4 managers, 8 assistants, and 48 workers. All of the employees are domestic. One main assumption to keep in mind is that the specific type of activity of this company is a general industrial commercial activity. This would allow us to measure all the general taxable activities that would apply for this case study company. The company produces a light manufacturing good and sell it in the domestic market. It does not participate in foreign trade. There's no importation, exportation in this case scenario. And the assumptions continue to include a specific standardized assumption about the turnover of the company, the cost of goods sold, the different assets the company owns, the different expenses the company incurs in a specific year, the provisions set aside by the company, and so on and so forth. Here are some examples of the further assumptions that we include. For example, we do specify the wages that these managers, assistants, and workers earn in a specific year. All of the assumptions of the financial statements of the company are based on a coefficient of the per capita income of every country. We also assume that this case study company will pay additional medical insurance for its employees. This additional medical insurance is not mandated by any law. It is a benefit that the employer is providing to its employees. Some examples of assumptions of the assets. The company owns 2 plots of land at the beginning of the second year. There's a building which is used for production and storage. The company owns light machinery used for manufacturing of this type of good. And we have office equipment such as chairs, tables, copiers, etc. And IT equipment, which would include laptops and phones, this type of technology in place. and it owns one truck as well that it used to basically sell its product at retail. One assumption we also have in place, which is that in the beginning of the second year of operation, the company will actually sell one of its plot of land and use the proceeds, half of the proceeds of the sale, to expand the building. So this allows us also to measure the tax bill associated with this transaction of the selling of the land. In terms of expenses, the list is quite comprehensive about a series of detailed assumptions on expenses and transactions. For example, advertising expenses, royalty payments. We assume that we will buy insurance for the building. We have owner's expenses also part of the assumption, and startup expenses as well. Now, for the first sub-indicator, total tax and contribution rate. There's few dimensions here for us to consider that would explain the methodology of the sub-indicator. First, what is a tax under the doing business definition? Doing business departs from the standard definition of tax. Because it measures the imposed charges that affect business accounts and not government accounts. This is very important, especially when we are measuring or looking at labor contributions. Labor contributions that are mandated by law, but that are requited to private funds, not to government funds, would be included here in this sub-indicator. So the categories would include profit taxes, employment taxes, including mandatory labor contributions, any property tax or road tax, municipality fees, turnover taxes, and other more smaller fees that this company must pay. Another dimension that is important to understand is the differentiation between taxes borne by this company and taxes collected by this company. Taxes borne are those taxes directly that are a cost on the company. So they do affect the financial accounts or the business accounts of the company. Only these taxes are included in this sub-indicator because these are a direct cost on the company. Taxes collected, that means taxes withheld by the company and remitted to the authority, are not included in the total tax and contribution rate. This would be, for example, value-added tax or any other type of consumption taxes, or it could be the employee share of a labor contribution. This is because this sub-indicator is measuring the tax burden on the company. So the incidence of the tax falls on the company. Only those that are borne, therefore, would be included here. We also have to differentiate between statutory rate and this measure, which is total tax and contribution rate. The total tax contribution rate differs from the statutory tax rate. The statutory tax rate is just the rate provided in the law that you would apply to the tax base. The total tax contribution rate is basically that actual tax amount that you have to pay divided by the commercial profit. So it's expressed as a percentage of commercial profits. It is, in other words, a measure of the effective tax rate of each tax borne by the company. Commercial profits are basically the pre-tax profits of this case study company. Number of tax payments is the second sub-indicator. What does it measure? We are measuring here the total number of taxes and contribution that the company must pay. We do want to understand how are these taxes filed and paid, the frequency of filing. So for example, do I have to file and pay every month? If it's every month, then the number of payments would be 12 in a year. If it's quarterly, it would be 4. If it's once in a year, the number of payments would be 1. The taxes here, in this case, the taxes directly that are a cost on the company, taxes borne, and the taxes that are withheld by the company, both are included under the sub-indicators. Because this sub-indicator wants to measure the frequency of interaction between a taxpayer and the tax authority. So the taxes withheld, although they're not a cost on the company, they are administered by the company. They are thus included here. We have two rules that we want to take into account in the number of tax payments. First rule is about electronic filing and payment of taxes. If such a system or platform exists in a country where a tax could be filed and paid by the taxpayer, and if the platform is used by majority of companies similar to the case study, and there is no follow-up with any hard copy, so there's no requirement to resubmit the return in paper or submit the invoice in paper. Instead of counting all the several interactions in the number of payments, we will only count one payment. If we take an example, let's say value-added tax in a country, it's required to be filed and paid every month. So by law and in practice, the number of payments is 12. However, if the filing and payment is done electronically, meeting all of the requirements I just explained, instead of 12 payments, we will actually record one payment. This is a way to give credit for the existence of a good platform for online filing and payment. The second rule that we have is about joint payment. When two or more taxes or contributions can be filed in the same form and paid in one bill, in one transaction, in one wire transfer, then we will not be double counting all these contribution taxes. We will only count once. The third sub-indicator is the number of hours for complying with the tax obligations. In here, we are only measuring the compliance time for the three major taxes that typically firms have to comply with. Profit taxes, any kind of consumption tax, could be VAT or GST or sales tax, and labor taxes, including all employment taxes in payroll taxes and contributions. This is the number of hours per year that the taxpayers have to spend to do three main steps. Preparation time, so the time you actually do spend on gathering data from internal records, from books, trying to have to do some adjustments from accounting to tax, the hours spent to calculate the amount, all of that is included in preparation time per year again. Filing time, the time to actually complete or fill this return the form and to submit it to the tax authority. And the final step is payment time, time needed to verify the amount you have to pay and make the payment, whether it's online, through a bank, by mail, or going in person to a tax office. Again, this is measured in terms of hours per year for compliance. The last sub-indicator that we have is called the post-filing index. It is a score between 0 and 100. This index is a bit more complex in what it measures compared to the other three indicators. And therefore, I will have additional slides to explain more details about this component. So you see in this pie here, we are looking at two processes. One is the more purple and one is the yellow. So up to doing business 2017, in fact, the indicator only included three components. And we were only looking at, we would end the process at the moment of filing and payment of the return. However, there are a lot of interactions that happen after the filing and the payment, which are important to assess between the taxpayer and the tax authority. These are the post-filing interaction that we want to measure. That's why this score, this component is called post-filing index. We look at two processes. The process to request and obtain a VAT refund related to a capital purchase. And here we have two components under this process, time to comply with the VAT refund and time to obtain the VAT refund. The second process, which is in yellow, it's the process to rectify or amend a corporate income tax return and to undergo a corporate income tax audit. Similarly, we have two components here, time to comply with this correction in hours and time to complete the CIT correction in weeks. So to summarize, the index itself is in fact comprised of four subcomponents, and these four subcomponents are time components. We can go into a bit more details here. So as I explained, the VAT cash refund is basically based on a very specific scenario as well. We are only looking here at the case of a capital investment. We assume this company in the month of June will make a large capital purchase of a machine, an industrial machine. And it will pay VAT on this machine if this is applicable in the country. As such, the VAT in the month of June, VAT paid on the input plus VAT paid on this purchase will exceed the VAT collected on the output side, which means that we have now a VAT credit. What we want to measure is the time to comply with requesting for the refund and the time to obtain this refund. Time to comply with and conclude an audit is included actually in those two components when the request for this VAT refund would trigger or would lead to an additional review or a formal audit and acquired by the tax authority in 50% or more of cases before they approve the audit. So if in 50% or more of cases there is an audit that takes place, we also want to measure the compliance with this audit and the time to complete the audit as part of those two components. So time to comply with the refund in hours, basically we want to understand how you request this refund. Do you have to do some calculation? Do you have to complete a separate form? Do you have to submit additional documents to prove the purchase of the machine? Do you have to submit the invoice? So we want to understand how much hours you spend on these type of tasks. If you need to go to the tax office to represent your case, how much hours spent doing that? And in the case of an audit taking place, how much time you spend preparing any documents asked by the auditor, and time spent to submit those documents. The time to obtain the refund, the second component, it's basically how much time it takes from the moment I request the refund until I obtain it, until I receive the money basically into my account. If there are any delays waiting for the audit to start, delays because of requests from the auditor, let's say all of these would be included under this component. It's measured in weeks. The second post-filing process, as I have explained in the beginning, we are looking at a correction or rectification done to the annual corporate income tax return. The scenario is as follows. After submission of the annual corporate income tax return, the taxpayer realizes that they've made a mistake in the calculation of their tax liability. This is a simple error. It could be because of the use of incorrect tax appreciation rate or incorrect treating of an expense as a tax deductible. And they want to rectify or correct this return. And because of this error, there is an underpayment of the liability. Basically, the taxpayer owes more money to the tax authority as a result of this mistake. One key thing here is that we assume the taxpayer himself, the company, discovered this error voluntarily and they notify the authority voluntarily. Basically, they go to the authority and they say, we want to amend and we want to pay that difference. What we measure here are also two time components. One is called time to comply with the corporate income tax correction in hours. And the second one, time to complete a corporate income tax correction in weeks. Similar to the VAT refund scenario, we also want to understand if in this case, this type of scenario and this type of company would be pulled into additional review or not before we agree on the final tax settlement. Now, the threshold here is if in 25% or more of cases, of similar cases, they get exposed to a review, then we will also measure the time to comply and the time to complete this corporate income tax audit. So the time to comply with the corporate income tax correction, which is in hours, in here we want to know how you amend, how you rectify, and how much time you spend doing that for the return. How much hours spent gathering against some information, doing calculation, amending the return. Do you have to submit a new one? Do you have to go in person to submit a paper amended return, or can you do it online? How much time also you spend in hours to make that additional payment? And if there is an audit that takes place per the rule that we have of 25% of more cases, we also want to measure in here the hours you spend responding to the auditor, preparing any documentation requested by the auditor, and submitting those documents. The second time component, the time to complete a corporate income tax correction in weeks. In here, technically, this is the time to complete the corporate income tax audit if it takes place. So the time for the tax audit to start until the time for this audit to finish. So that would include the waiting time for it to start, the time you spend interacting with the auditor, the time you spend waiting for the audit report or the result or notification to come out, and the final settlement. So the time spent waiting for the tax auditor to issue the final tax assessment. That is measured in weeks. So all those four components of time, again, two under the VAT refund scenario and 2-time component under the corporate income tax correction, they make up what we call the post-filing index. So we take those 4-time components, we transfer them into a score between 0 and 100, and then the post-filing index is the simple average of the scores of those 4 time components. What is not measured under the paying taxes indicator? So we are looking here at a simple case of a simple product that is think of a light manufacturing product. So this product is not subject to a special tax regime. We don't look at this type of product like liquor or tobacco. Because the company is completely domestic and it produces in the domestic market and sell in the domestic market, this measure does not include tariffs and other custom duties. And because this company is a general medium-sized manufacturing company, we don't look at taxation in any special economic zones. And finally, when it comes to tax incentives, we only account for tax incentives that are based on the age or the size of the company. By age, for example, if there are tax incentives for newly incorporated company, 2 years, and incorporation or 3 years, this we would take into account. That is related to the age of the company. Or incentives related to the size of the company, for example, companies with a turnover X or turnover above this or number of employees, they can, let's say, apply a reduced rate, or they can have an accelerated depreciation of assets. So because these are related to the size of the company, we will include them only for those 2 criteria. The last section of this presentation is sharing with you some international good practices in the area of paying taxes. We know very well that in the past years, there's a lot of transformation towards the use of digital technology in different public service and different public agencies, including the tax administration. We see a popular trend since, I believe, 8 or 9 years ago of countries implementing or enhancing already existing online platform for filing tax return and paying the taxes. We also see digital solutions beyond filing and payment, such as hotline services to answer questions by taxpayers, giving you access to historical returns. You can see the historical returns and payments of taxes. So there's different also new innovation on the digital side. Another good practice is adopting a simple one tax-based system. This means for the different taxes, typically we see in the labor taxes contributions that are based all on the gross salaries. Some countries apply the same rate, one rate for all of them, and then in the back office, they would split the collection between this goes to the health fund, this goes to the unemployment, this goes to contribution. Or if not one rate, you could have different rates, but the requirement is that you can file in one form and pay in one amount all these different contributions that are based on the same tax base. We see also good practices in the area of tax audit. Countries are implementing risk-based tax systems for selecting companies for tax audits that are also automatized, and either by color coding or by certain numbering or certain letters. And then we have a lot of, we see trend as well in looking at the VAT refund process, improving that process, making it faster while also taking into account the risk level of the taxpayers, allowing for the request to be done online, being more clear and transparent about the requirements to process a VAT refund, or in case a VAT audit takes place, what are the documents required, how is the process basically completed, and allowing for certain time limits to be introduced and applied in practice. This concludes the presentation for today. I hope this helped you to understand better the methodology of paying taxes indicator. You can also visit the website doingbusiness.org, and you can go there to the methodology tab, and you have more details about the different sub-indicators that I have explained and about the good practice in the area of paying taxes. Thank you.